This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.
Hey, good morning. I'm Jeff Farnham. Last week we discussed that as of September, the Federal Reserve raised the benchmark interest rate for a third time this year. The Federal Reserve's interest rate hike can have an impact on mortgage rates, causing many prospective home buyers to track news headlines closely. With the latest hike and an additional hike possible later in the year, you may be wondering how this Federal Reserve affects mortgage rates. The Fed doesn't actually set mortgage rates. Instead, it determines the federal funds rate. This is the rate at which banks and other financial institutions lend money to one another overnight to meet mandated reserve levels. When the federal funds rate increases, it becomes more expensive for banks to borrow from other banks. Those higher costs may be passed on to consumers in the form of higher interest rates. Mortgage rates are largely determined by the secondary market, where mortgages are bought and sold. Fannie Mae and Freddie Mac are two government agencies whose job is to keep the mortgage secondary market stable. They set prices each day as determined by the secondary market. They offer a guaranteed price to buy a certain type of mortgage. The rates change each day based on the market. Mortgage rates most closely follow the 10-year Treasury bond, but this is not an exact science. It is only used as a benchmark. As bond prices go down, the yield goes up. Mortgage rates in the secondary market must then also rise. As with the stock market, interest rates tend to move up and down. When the economy is strong, rates are higher. When the economy is slower, rates tend to drop. Generally, all mortgage lenders have access to the same rates. When you try shopping rates, you may very well be comparing apples to oranges. You must compare rates on the same day, at the same time, on the same type of loan program, with the same points, and that's virtually impossible. So after the secondary market determines mortgage rates, how are your personal mortgage rates determined? We take a thorough look at your credit report and scores to determine the options available to you, what type of loan, the amount you're borrowing, the term, your credit scores, blemishes on your credit report such as defaulted payments, liens, or bankruptcies, or if you have a high debt-to-income ratio. All these are factors in what interest rates you qualify for. You need to know when you're working with JTS & Company, we are working to get you the lowest interest rate possible for your specific situation. It doesn't benefit us one bit for your rates to be higher. We are here to make sure you get the best deal we can offer, saving the most money possible and meeting the goals you set to accomplish with your mortgage loan. We believe an interest rate is a tool to help you meet your goals and only matters if your loan closes. Whether you are a first-time home buyer, right-sizing, or need to refinance, give JTS & Company a call. We are local, trusted, and experienced, and we work hard for you. Thank you for joining me today, and be sure to tune in next week.
This JTS Mortgage Minute is brought to you by JTS & Company Mortgage Professionals.